In today's session, we're going to talk about a few more ideas about investing, and I might go into a little bit more detail to help you understand the process. Now, I hope that you've had the opportunity of maybe watching the first and the second session, because what I'm doing here is I'm building and I'm putting layers on the foundation that I've already constructed. Nonetheless, if you haven't seen any of the two earlier videos, you'll still find today's session to be quite interesting. Let me very quickly summarize the last two sessions. I think it might help. In the first session, we talked about investing. We talked about the basics of investing, and I explained where you have to start. In the second session, I went into a little bit more detail about investing, and I talked about what investing is. I gave a definition. I gave a series of questions you should ask yourself before you start investing, and those questions would serve as a guide to lead you down the right path. And then I finalized by talking about the principle of value investing, a concept that many people have come to associate with. It's a philosophy of investing where you're trying to buy things for a bargain. You're finding things that are selling at a discount to their intrinsic value or to what they're worth. And by doing that, you're allowing yourself a margin of safety that ensures that, number one, that if you're wrong with your analysis and your assumptions, it ensures that you never lose money or you don't lose too much capital, but it also ensures that you're able to maximize the potential for gain. Those were the two key things that we talked about in the last two sessions. Now, in today's session, I want to go a little bit further and talk about investing. If you're joining for the first time, this is a very simple series. That you wouldn't see charts, you wouldn't see calculations, you wouldn't see explanations that are very deep in terms of emotional, trying to explain the emotional side or the psychological side to why we do what we do. I'm not going to talk about any of that. This is very simple for the average person who wants to know a little bit more about investing. And I'm doing this simply because when I started my journey of investing, I couldn't find very simple information to guide me. Well, maybe I should rephrase that. I hadn't disciplined myself on how to search for the information, because the information was out there, but I hadn't found it. And part of the reason was because I, for some reason, was led to believe that you have to, if it's not complicated, then it's not good enough. And many people have taking that approach to investing. They want it to be complicated, and some others actually just think because it sounds too complicated, I'm not interested in investing. But I can assure you and I can tell you that investing is very simple. It's very enjoyable. It's actually quite interesting. But all it needs and all it requires is time. Now, having said that, let's begin. If you want to start your investment journey, you've decided, I like to invest. One of the questions you might ask yourself is, what do I invest in? What asset class do I invest in? The first step that you have to go through is to understand how assets are classified, the classifications of assets. If you understand asset classification or investment classification, the whole process is demystified. The reason is because if you can classify an asset, then you would know how to value an asset. Let me make this a little bit more simple. Assets generally will fall under one of many categories. I'll give you four. There might be what you call assets, income producing assets. And those are assets or investments or opportunities that generate income as part of their either annual return, quarterly return, or monthly return. So they produce income. You might also have what we call commodities. A commodity is an investment category where what you're investing money in or time or resource in is used as a byproduct, as an ingredient to create another asset. A good example of a commodity could be silver or corn, which is used as an ingredient to make something else. So corn is used to make other types of food. So if you want to know how to value or price a commodity, you have to understand what is its use, what is its function, what is its use function. And you must understand how to either look backwards to the past and understand what it's been the price that it's been trading at for that period of time. And you can use that as a way of projecting into the future. I'll come into the detail of that in the later session. So don't get too hung over what I just said. The third asset class is what you will call a collectible. Something that is precious, something that you, for some reason, have an emotional attachment to. A collectible could be art in terms of an artwork. It could be maybe a painting. It could be a sculpture. It could be gold, for example. These are all collectibles. Collectibles are quite unique and quite rare because it means that for a collectible to have value, someone else has to perceive its value to be slightly higher than what you believe it is worth. So, for example, a piece of art painted by Picasso has a lot of value. Why? Because we appreciate art. And someone is willing to pay millions over that artwork. There are other artists who have beautiful paintings, even as beautiful as Picasso's, some even much more beautiful than Picasso. But in the minds of the people, on the emotional level, we haven't connected. We don't believe it's worth the same as a Picasso. So collectibles are quite interesting, and therefore the way you value collectibles is different. So you have income producing assets, you have collectibles, you have commodities, and finally you have what we call currencies. A currency is simply a means of exchange. Whatever you can use as a means of exchange. Money in the form of currency is a means of exchange. You have the pound, you have the dollar, you have the euro. Those are all currencies. But those are not the only forms of currencies, because we've had currencies in the past. Currencies, therefore, have to be measured against other currencies in order to ascertain value, because the value of a currency is based on what I can exchange the currency for, and in many cases is relationship with a different currency. Gold used to be a currency, and in many ways the pound and the dollar was backed by gold. So you would say £100, the value of £100 back in the very early 1900s was worth a certain amount because it was connected to a certain weight of gold. So it was simply an indication, a relationship connection with another currency. Back then it was gold, but gold was difficult to travel with. So people would say, well, I have this, what we call a promissory note, a promise to pay. It's £100, but it's backed by gold. Therefore, we think it's worth this amount. Those are 4 asset categories in terms of how you can classify assets. Now, why is this important to you? Well, you have to understand the classification of an asset before you can put your investment capital into the assets. The reason you're asking yourself this question is because not all assets can be valued. Now, I talked about value investing previously. I'm going to say something that's slightly going to contradict what I said in the previous session. I said that value investing requires that firstly, you identify the intrinsic value of the assets, and then you determine a price that you're going to pay. And that price has to have a margin of safety such that the price you're paying is way below its intrinsic value. That is value investing. But you notice that I mentioned 2 interesting words, price and value, and they have a relationship. Not all assets can really be valued fundamentally. By fundamentally, I mean by taking away all emotions and by doing what we call a detailed analysis, quantitative and somewhat qualitative. Income producing assets you can value because you can simply say that the income is producing every month or every year. I can take that income, I can project into the future, I can determine what the present value of all the future income it will generate will be. I can discount it back to today's present rate using a discount rate, maybe using maybe a bond interest rate, something that is safe. You might say 3%, you might say 4%, you might say 5%, doesn't matter. But you can identify and calculate all of the future income this asset will produce over its entire lifetime. You discount it back to the present day based on its discount rate. And then you can say, well, if this asset is going to give me £100 over its entire life, and I'm paying £20 in today's money, when I've discounted it back, I still have 100. Therefore, its value is much higher than what I'm paying for it, and therefore I can invest. That's a quantitative way of doing a valuation. Commodities, on the other hand, are slightly different. Can you value commodities? Somewhat. You can. Not all of them, some of them you can. Collectibles are a little bit more difficult to value because it's based on opinions. It's based on what you believe is worth against what someone else believes it's worth. And in many cases, you're believing that this asset will go up in value, which is a risk. And finally, currencies are difficult to value. So with all these forecast classifications that I've just given you, there's a constant, and that is that you may not be able to value all of them. But what you can do is price all of those assets. You can say, I think it's worth this amount, not based on value, just based on pricing. So with commodities and with collectibles and with currencies, you can price. How do you price? You compare against a benchmark. So you might say, well, I'll give you a good example. Let me make this a little bit more practical. Facebook is a company. If you want to buy Facebook or buy a share in Facebook, you might say, well, Facebook is quite similar to, let's say, which company? You might choose a company, let's say Instagram. Now, I know Facebook has acquired Instagram, but before the acquisition, you could say, let's compare Facebook with Instagram. You might say Instagram is selling for a certain price. Therefore, Facebook, using Instagram as a benchmark, could be at a certain price. This process of comparables, of comparing one asset with another within the same category, is what we call comparables approach. It's very similar to what's used in real estate or property investing. You want to buy a property, how do they put a price on a property you're trying to buy? If you've ever bought a property, then you know something interesting happens. The agent will give you a price. In many cases, the price of that property is based on what possibly other properties are selling for on the same street or in the same area. It could be based on what someone else sold previously. So it's always a comparable with something similar. That's comparable. That's the comparables approach. So you can price certain assets. Gold can be priced. Currencies can be priced. Artwork can be priced. And I've said all of that to make a point. Now, when you start your investment journey, if you can't classify the asset, you can't value the asset. And even when you've done the classification, it'll become clear that you can't value. In many cases, if you really want to value an asset, it has to produce income. It really has to produce income. There are some assets that may not produce income, but you can still value them. Real estate is a good example. Companies are good examples of assets that may not pay you income, they may not pay a dividend, but you can still value them because you have historical information that you can use in your analysis quantitatively and qualitatively. But there are some assets that you cannot value. What you must do is price them. Now, having said that, let me take you maybe one step further. When you decide you want to invest, one of the first things you have to recognize is that you as the investor, you fall under two categories. You might be passive or you might be active. Now, I'm not saying passive investing and active investing, no. I'm just talking about how you should perhaps categorize yourself. Passive investing normally falls under the category whereby you're lending money. Active investing is where you are actually taking a position of an owner. Now, this is very interesting, but very simple. Let's make it more practical. Within the lending category or the passive category, you have things such as maybe a bank or building society that pays you an interest. You have a savings account. If you have a savings account and you put money in your savings account, or you put money in a current account and you're being paid interest, that is investing. But the process has an agreement. The bank says, well, we're going to pay you a certain fixed interest, and the interest will increase if you're willing to keep your money with us and leave it in the account. Sometimes they might ask you to have it fixed for 12 months, and they might give you 1% interest return. But you must keep the money during that full duration. If you take it out, they might not pay you any interest. That is investing, but it's the simplest form of investing. You're effectively giving your money to a bank or a building society, and they're paying you interest. Or you're putting the money in your account, which is still the same as giving your money to the bank, and they're paying you interest. You are lending your money to an institution. That is very basic, very simple. The second part, or the second level, or higher level in the lending category, is where you go into what we call bonds. You may have heard of bonds, and there are various types of bonds. You have government bonds. In the UK, we call them gilts. You have bonds. You have government bonds. You have sometimes, even depending on where you're watching from or where you live. In the UK, we have local governments. Some other countries, they might have what they call municipal bonds, which could be federal and local, or federal and, state, not federal. Well, yeah, we can put that federal and state, government bonds. You also come down further, you have what we call corporate bonds, which is a company issuing bonds. But a bond is simply a promise to pay. You're still lending money to either the government or an institution or a third party, and they have agreed that they will pay you a certain fixed interest, or even sometimes variable interest, for having your money. There will be conditions that have to be agreed. For example, they have to keep your money for a certain duration, and they'll pay you a certain fixed amount or variable amount on a scheduled interval. That is the process of what I call passive investing. You're not really doing anything with your money. Now, the advantage of both these passive methods is that when you put your money out, depending on who you give it to, you're usually guaranteed. Well, you're promised. You're not guaranteed, you're promised a return of your original capital. In addition, you're promised a return, but the interest you're getting back is quite low, primarily because it's safe. Remember what I said about investing in the earlier sessions? You're trying to understand the relationship between risk and certainty. With lending opportunities, like putting your money in your bank, or buying into a bond, in many cases, the return is low because your money is guaranteed. So in many countries, and in the UK, for example, the money you have in the bank to a certain amount, sometimes 75,000, is protected. Even if the bank folds up, your money is protected by the government. So because they protect your money, what they pay back in interest is low. On the other side of the category of investing is what we call active investing. And here you become what we call an owner. You take what we call ownership rights. With the first, you're just lending money. There's a saying that the borrower is servant to the lender. So with the first option, you're borrowing money, you're lending money to someone, and they're going to give you back money in return. With the second option, you're an owner. The structure is ownership. I'll give you a good example of what that means. You might have investments in property, where you buy a building or you buy a piece of land. You own the piece of land. Now that piece of land, depending on how you use it, could pay you an income every month, or that real estate property could pay you an income every month, but you own the property. Or you might be a part owner in the property. Maybe you own it with other people. Another approach is what we call investing in a company or corporation, but it has to be what we call a public company. Within companies, you can invest in a private company or you can invest in a public company. A private company is simply a company that is, for example, a limited company where the shareholders are closed. They've selected a number of people to be part of their shareholder group. Their affairs are private. They don't have to disclose anything to the public. Effectively, you run your business the way you want to. You don't have to report to anyone. With a public company, you open up the operations, the management, the disclosures to the public. So you sell some of your shares to the wider public, and therefore you're now liable and responsible for reporting back to your shareholders. But you can invest in a company, and having a company ownership means that you fall under the second category of the active investor. Now, these are the two categories. So if you bring back what I explained about you categorizing or classifying assets, I said you have income producing assets, you have, I said commodities, you have currencies, you have collectibles. You have to first of all ask yourself a question. What category am I really passionate about? If I'm an owner, I have responsibilities. There's certain things I must do. If you own a property, there's certain responsibilities you have. If you own a company, there's certain responsibilities you have. Whether you are an active or managing owner, or maybe just a shareholder, you have responsibilities, and those responsibilities requires you to ensure that you're constantly aware of what could change within the investment, and you know your rights, you know what you should expect from the people managing your assets or even yourself. Those are the two categories. So starting your investment journey requires, number one, you understand classifying assets and what it entails and categories that you can invest in. So you now have a choice to make of choosing what asset class do I choose as my vehicle to get me from where I am now to where I want to be. I'll give you a good example of how this might work. I won't go into the detail. We can cover this in the later sessions, but let's give a good example. Your age should always be a very important factor when choosing an investment approach. Your earning ability should always be an important factor when choosing an investment approach. Your personality, in terms of how adverse are you to risk, should be used as an important ingredient when making an investment decision. All of these help you choose. If you go down the path of lending and you say, okay, I'm just going to put my money in a bank account, there are disadvantages and there are advantages. One advantage is your money is secure up to a certain amount. The disadvantage is you don't get a lot of interest. As a matter of fact, my bank, for example, pays 0.25%. However, the inflation rate right now is 3%. So it means that the purchasing power of what I've put in the bank, which is a currency, because the currency depreciates in value due to inflation, it means that at the end of every year, I lose 3% of the purchasing power of whatever I have as money. So money is not a good asset because it depreciates in value. However, if all I want is security and liquidity, access to my money regularly, I might choose to just put my money in a bank account. On the other hand, I might choose to put my money in a bond. But bonds are usually more suitable for people who are much older. If you're in your early 20s, 30s, you shouldn't be investing in bonds. Now, this is not financial advice. Let me make that very clear. But the point is that a bond promises you fixed income is what we call fixed income investing. Unfortunately, you must understand the relationship within interest rates and what the bond pays in interest. Because if the inflation rate goes up, the value of the bond goes down. If inflation rate goes down, the value of the bond goes up. The most important thing with bonds is that they promise you a fixed payment and a return of your capital. What happens with bonds, whether it's a government bond or whether it's a company bond, is you do not participate in the growth or the capital gain of the company or the country. What that means is all you get is what you signed up to do. If the company said, okay, we'll pay you 5% for our bonds and we'll give you back your money in 20 years, and during that period, they earn 50% in terms of return because they've been managing the company really well, you don't get to participate in that extra 45%. All you get is the 5%. So there are downsides. But what it gives you is some level of security and certainty, especially if you've gone for a government bond or you've gone for a municipal bond or might say a very highly rated bond, like a bond of a corporation with maybe a AAA rated company. That's all you get. On the other hand, if you move into investing in a real estate or in a company, you get to participate in the capital gain or appreciation and the income gain. However, you also get to participate in the risk of loss. So with ownership structures of investing, you share the loss and you share the gain. With lending investing or passive investing, either saving your money in a bank account or bonds, you don't get to share the loss because that is the risk the company takes. They've promised you that they will pay you that fixed amount. That's what you've agreed to. But as a result of that reduced risk, your return is low. If you want something higher, then you must move over to ownership, where you say, okay, I'm going to buy a property. I'm going to invest in what's called a real estate investment trust, which is a company that buys properties and they manage it on your behalf. Or you might say, I'm going to buy into a company. Either I'm going to buy into a private company or I'm going to buy shares of a public company. Those are the options you have. It's really that simple. Now, the other assets that we've talked about, such as collectibles and commodities, you have to then decide how to invest in those, because you see, those asset classes, unfortunately, do not pay you an income. They don't pay you an income, except you've agreed to a structure. For example, you have a piece of artwork, maybe a Picasso, and you lend this painting to maybe an art gallery, and there's an agreement that they will return the painting back to you, and because they're putting it out to the public and they're raising money, the Mensah will pay a royalty of a certain amount every month. If you can structure that asset in that way, then what you now have is an income producing asset, although it's still a collectible. But those are some of the thoughts that I'd like you to consider and think about. And as we move forward into the following sessions and the future sessions, I'm going to start picking up each of these assets individually, and I'm going to start showing you how to invest in each of those assets and how to begin. The process, I can promise you, is very simple. If you're willing to stay focused, if you're willing to invest in yourself and you're learning like you're doing right now, you'll find it to be a really exciting journey. One thing I can share with you is this. It doesn't require high IQ to be a good investor. In many cases, what you really need is temperament, emotional control. You need some level of intelligence, but it doesn't have to be an IQ of 150 or 160. No, you just need a basic understanding about how numbers work. But what you do need is emotional control, the ability to control your emotions, the ability to think independently, the ability to be contrarian in your approach. Everyone is saying perhaps you should buy this particular company, and you say, no, well, I don't want to follow the herd. I'm going to go away, sit down, do my analysis, and whatever my analysis says, I'll go with what the results of my analysis indicate, whether that be for or against what everyone else is doing. So I hope it's been useful. We'll follow up in the following sessions, and I'll talk about a few other asset classes, and we'll very quickly move into how to begin the journey, what to invest.